Welcome, everyone. Thank you so much for joining me. And as always, a special thank you to every single one of you who has become a subscriber on. Is the Federal Reserve on the verge of more aggressive interest rate cuts this year, or will it change course? The Federal Reserve just sent a message, and it is not the one that many investors or policymakers were hoping to hear. This week, Federal Reserve Chair Jerome Powell made it very clear. Interest rate cuts are coming, but don't expect them too soon. Speaking in Providence, Rhode Island, Powell struck a very cautious tone, emphasizing the delicate balance that the Federal Reserve is facing between taming inflation and protecting the job market. His remarks came at a critical time, of course. The U.S. economy is now sending flashing red signals. Inflation remains above the Fed's 2% unrealistic target. It has been increasing in recent months, but right now the labor market is starting to soften. So this is the worst case scenario. Recently, I uploaded a detailed video on this very subject. You're welcome to watch it next. Some officials within the Federal Reserve, along with outside voices, mainly from the White House, are urging for more aggressive rate cuts to support employment and, of course, to align with Trump's economic agenda. But Powell, well, he's still not ready to rush. Let's break down his most recent remarks. I think this is very, very important, and it will tell us what to expect moving forward. At the heart of the Federal Reserve's mission are two goals: maximum employment and stable prices. And this is what we refer to as the Fed's dual mandate. In the past year, official inflation has been somewhat cooling, but not disappearing. And at the same time, unemployment is edging up. The Fed is trying to walk a very tight rope, lower rates too quickly, and they will reignite inflation, keep them too high for too long, and the job market would collapse. Last week, the Federal Reserve made its first move of the year, cutting its benchmark interest rate by 25 basis points. It was a small step, and according to Powell, a necessary one given rising unemployment. But during that same press conference when Powell announced rate cuts, he also admitted that it is, quote, challenging to know what to do. It is very unusual to hear that from the Fed chair, and of course it is clearly a sign of just how uncertain the path ahead really is. Fast forward to this week, and Powell doubled down on that caution. While acknowledging the risks to both sides of the Fed's dual mandate, he didn't really indicate any immediate follow-up cuts. His message was very, very simple: better to be careful than reckless. If we cut too aggressively, Powell warned, we would leave the inflation job unfinished and need to reverse course later. In other words, slashing rates too fast could cause inflation to rise again, and then the Federal Reserve would have to raise rates all over again, start it all over, potentially causing even more economic damage. But not everyone at the Fed agrees with Powell's slow and steady approach. There is a growing divide within the central bank. On Monday, for example, this week, Stephen Miron, a Fed official who was appointed by Trump, came out with a starkly different message. He argued that the Federal Reserve should, quote, slash its key rate to as low as 2 to 2.5%, nearly cutting it in half from where it stands today. So very, very aggressive initiative. Myron's rationale is presumably that the labor market is weakening and inflation is showing signs of calming down. And so he believes that waiting too long could let economic cracks turn into full-blown fractures. Do you agree with this approach?